Hello again, and welcome to our latest IC Future of Private Investing session. I'm Dave Baxter from the IC, and this time we're bringing together a couple of things from the last two sessions. We've already discussed some of the big debates about ETFs and the outlook for that kind of fund structure. And before that, my colleague Mary McDougall looked at some of the big megatrends available to investors via investment trusts. I think it's fair to say that both fund structures have had something of a boom in demand in recent years. Quite recently, we've seen trust seen as a really appealing play on some niche esoteric trends and so-called alternative assets, whereas ETFs for quite a few years now have been viewed as a simple way to some very strong returns and also perhaps a way to sleep at night without worrying too much about what's in your portfolio. But as always, the question is, which fund structure is now best suited to your needs? And that is particularly important as things kind of start to look a bit rockier and a bit more unpredictable. In this session, we are going to pit the two fund structures against one another. We've got specialists from each side of the fence who will hopefully argue for, where an ETF or an investment trust might serve you best. Of course, I'm sure you've heard the active-passive debate many times, so I want to try mainly to sidestep that and instead go a bit more granular and look at what the different fund structures will offer in different areas. We're going to try and focus on some really kind of interesting, appealing areas to investors, from income to the thematic space and to ESG. We're also generally going to be looking at where certain structural traits of the different funds might make one stand out more over another in a certain situation. So in just a minute or so, I'll get going and I'll introduce our excellent panel. First of all, we are going to run a poll. So we're going to be asking what you, the audience, view, what you think on this subject. We're going to take your results, and then at the end of the session, we will reveal them and just kind of, take the temperature, I guess. So with the poll, you simply need to scan the QR code that's now up in order to get involved. The question itself is, I think, pretty binary. It simply asks you, are you team investment trust or are you team ETF? Of course, the answers can be a bit more nuanced and the options there do reflect that. So you have four options. One is, I'm team investment trusts. They have provided access to high quality returns over generations. Option two is I'm team ETFs. They provide reliable returns for affordable prices. Three is both. It's important to find the right structure for your portfolio. And four, quite an interesting choice, is neither. I prefer to pick my own stocks. And I know there are certainly some IC readers who may well go down that road. So thank you for everyone who's getting involved in that poll. I'll be really interested to see where people have kind of fallen on that spectrum at the end. And now it is time, as I mentioned, to turn to my excellent panel. So if you watched my session just before, you will already be acquainted with two of them. One of them is Deborah Furr, founder of Women in ETFs and an authority on all things ETF. We also again have Eamon Prendergast. He is Director of Palantir Financial Planning. As I've said before, he spent a long time considering different investment options, different fund structures, and he should be able to give an interesting balanced view on where one structure might appeal over another. I have then very politely borrowed a couple of guests from Mary McDougall's earlier session on investment trusts. So welcoming them back, first of all, we have Richard Stone. Richard is Chief Executive at the Association of Investment Companies. That's the trade body, and you could say the flag bearer for the investment trust sector. And I'm also very pleased to say we're joined again by Emma Bird. Emma is a research analyst at Winterflood Securities. So she has a lot of experience on going really in depth on both individual investment trusts and more broadly looking at some of the interesting trends that we're seeing in that sector. So once again, there's a tiny bit of housekeeping to get out of the way before we start. It would be great, again, to have some questions to put to the panelists and just make sure that we're kind of touching on the most interesting subjects in this debate. So please do use the Q&A function on the right-hand side throughout whenever any questions occur to you. Also, do remember this session will be available on demand for 30 days, a few hours after we finish. That's via the same link you're using now. And there are loads of useful links, resources, and a feedback form above if you wish to refer to that. So that's my preamble done. Thank you to all my panel for joining me now. As I said, I'm interested in focusing on some of the kind of hottest areas of investing at the minute, and just perhaps kind of running through what we might expect from the different two fund structures. You know, where is an ETF a really attractive option? What do we need to be aware of? And the same for trusts. And first of all, I wanted to pick up on something that we touched on in the last session, and also I believe we touched on in Mary's session earlier on. And that is what you might call thematics. You know, you also earlier discussed megatrends, which perhaps people might view as an interchangeable term. But you're seeing lots of kind of exciting new trends, lots of nascent industries, and both ETFs and trusts are launching to try and capitalize on that and get the very best out of those newer, interesting kind of hot sectors. A couple spring to mind, but there are many examples. The two I can think of are space. So if you're a UK investor, you could buy into a space ETF, trying to get into, listed companies there. Equally, there is the Seraphim Space Investment Trust, which takes a different approach. And then another area I thought of is the hydrogen economy. There's at least a couple of ETFs out there now that focus on that. And there's an investment trust which takes a really kind of different approach. So we were discussing ETFs before, so perhaps it'd be fair to first tackle it from the investment trust side. Emma, perhaps if you don't mind, I'll volunteer you up first. I'd just be interested on kind of, what your take is. How do you say in the space area, how do you think they're kind of approaching that? And I don't know if you kind of have any views on how it differs, or I can bring that in from other panelists, how it differs from what's going on in other kinds of funds.
So I think one of the key benefits of the investment trust structure is the closed-ended permanent capital nature. So in the investment trusts that are looking at space and hydrogen, as well as lots of other megatrends, they can invest in illiquid assets. So whether that's private companies or physical infrastructure assets, that's one of the key advantages of the investment trust structure, which I think differs from ETFs and definitely open-ended funds, where they would be accessing the theme by investing in listed companies. And then a key advantage for different trends is the ability for investment trusts to smooth their income, so they can retain a certain percentage of the revenue they generate each year, and then hopefully that can help contribute to a growing, steady, smooth dividend over time.
On the kind of theme side, and you mentioned that there's that kind of superior liquidity in the investment trust structure. I suppose what interests me is the fact that they are going into, with the examples we mentioned, they are going more into the kind of unlisted space and into private companies. And perhaps that's appealing because arguably you are accessing the trend maybe at an earlier stage, and you are kind of getting those companies when they have more of a runway for growth. But what does that mean for, do investors need to be more cognizant of the risks when it comes to those private companies, and what other kind of issues can come when you have a portfolio of unlisteds?
Yeah, I think it is definitely fair to say that they would be higher risk, potentially higher return vehicles. So we definitely say that they're suited to investors with a longer term time horizon, and a higher appetite for risk, I suppose. Within an investment trust structure, you need to be aware of the fact that the share price may differ from the underlying asset value as well. So you need to be able to deal with the share price volatility, particularly as the valuations will not be updated daily, so there can be a lag between the NAV and the share price calculations. I guess one of the key risks for trust investing in these type of assets is, as you mentioned, the underlying kind of illiquidity. So if there is a problem asset or company, it can be more difficult to exit, as there's not a readily available market. But that's why they're ideally suited to the closed end structure. So private investors themselves can still exit the investment trust, even if the manager can't exit the underlying holding.
Yes, yeah. I suppose you might have to stomach a kind of deep discount to get out, but like you say, you can at least get out, unlike some cases in the open-ended space.
Exactly.
On on the thematic space, Deborah, I wondered if I could turn to you because you did mention it in the previous session. That's been an area that's been very hot in the ETF space. Um, but what I suppose there have been some interesting criticisms though of thematic ETFs. You know, people worry that it exposes you to market timing, and you know you may end up simply buying into a trend when some people fear that it's actually peaking. And you've seen kind of people pile into things like clean energy ETFs, and then they've had a really difficult run. I mean, is there? I don't know if you'd have any views on kind of good basics in terms of when you're doing your due diligence on thematic ETFs. You know, what would you watch out for when trying to avoid those pitfalls?
Yeah, I think it goes back to what I had said earlier, is really making sure you understand what exposure you're getting. I mean, we've had themes that are like investing in airlines, right? So that's a very narrow slice of securities. And so it's definitely going to be much riskier because it's not a diversified portfolio. I think when we think about things such as disruptive technology, you want to think about what securities are inside of that ETF. So are they holding a lot of Microsoft and Amazon and other big tech companies, or is it really newer and upcoming companies? You need to understand what's inside of it, I think, is the most important thing. But maybe just to finish the contrast to what Emma was saying, I think ETFs, unlike closed-end funds or investment trusts, aren't closed-end, they're open-ended. And they then, because of the unique creation redemption process, don't trade at these discounts or premiums that you can find within an investment trust wrapper. You can choose to buy a share class that accumulates, or you can buy one that distributes. So there is some differences in the product structures, but there are ways to think about the pros and cons of the two. I think the other thing when you think about thematics is some of them are active. So many of you might be familiar with Kathy Wood, who's been in the press. And so she is very much disruptive technology, actively manages, tells people everything she owns and all the trades she does, etc. So you also need to know whether it is someone who is actively managing, or is it an index and what is it following? She's also been buying crypto and Bitcoin. So I think you need to look at what's inside of it and what are your views on that. So those products aren't actually available here in the UK, but given through the internet, it's hard to tell where products are available. I think many people would be aware of her products.
And it's interesting you make the point about kind of what you're happy having in a fund, which is going to seamlessly lead me on to perhaps it'd be interesting to discuss ESG to an extent, because I think, I mean, Eamon, you mentioned earlier, any fund is probably going to run the risk of the greenwashing pitfall, and as an investor, you now need to be quite careful. You sounded earlier like you felt kind of relaxed enough about kind of ESG in a passive sense. I don't know, is that kind of something that you've been turning to or just considering, or?
Yes and no. So I think again, I go back from what the client's looking for. So if the client is looking for something quite bespoke, then sometimes we have to use a sort of bespoke portfolio and look for sort of direct offerings, and that could include investment trusts. If a client has got a leaning towards ESG, then sometimes it would be better suited on the passive side, purely on a cost basis as well. And I think going back on the point on the investment trust side, the sort of 30% which they can hold in unquoted, I think it probably ought to be mentioned, but obviously that allows them to obviously profiteer to a certain degree on sort of the unquoted side, but it does also cause a lot more risk. And you've obviously got the 70%, which are the eligible investments, which obviously can help for a period of time while hopefully the unquoted side obviously recover. But I think a lot of investors don't always understand that side of it, the 30%, 70%, where from an ETF side of it, it's relatively easy to understand. They kind of get it straight away. There might be a bit of confusion over sort of index funds and ETFs, but on the whole, they kind of get it. I think from an investment trust perspective, obviously you can obviously go down the REITs route as well, which I know is not necessarily down the ESG side, but there's a number of different things I guess the investment trust can actually do. And that can include things like split capital trusts as well, which aren't quite as popular, but I think they can sort of help an investor as well.
Yeah, I mean, personally, I always think investment trusts perhaps come with more complications, but if you're an investor who's kind of passionate enough, then you can start to kind of take advantage of those to an extent.
Yeah, and
I just want to,
I think as well it can also be part of a sort of satellite portfolio. So I said for a lot of our clients, we may have quite a strong lenience towards passive funds, but if say 10, 15% wanted to go into sort of the investment trust or direct share offering, then that can give them a bit of balance as well with their portfolio.
yeah, yeah. So I want to turn to the briefly back to the kind of ESG side, and then maybe Richard, I'll bring you in here. I mean, it'd be interesting to hear. I mean, to what extent are you now seeing, trusts and kind of people who be your members kind of embracing ESG, and how many kind of different routes is it taking now? Are we getting kind of enough diversification of kind of options if you are kind of obviously ESG is such an idiosyncratic thing and people view it in many different forms?
I'd say absolutely, and you're seeing many of our members take it both as a central point to their mandate, so they're very ESG focused in and of what they do. The sector had a record year last year for capital raised, and the most popular sector for that capital was renewable energy infrastructure. So you can see, as the name on the tin would suggest, is very much in that sort of ESG. The E part of ESG and helping with that transition. But because of investment companies' ability to invest in those illiquid other assets, then they can invest in the sort of more nascent companies that haven't necessarily got to the market size yet, or haven't listed. They're still in the private sphere, and a lot of those are where the sort of new cutting edge technologies around batteries and different forms of transportation, renewable energy infrastructure, digital infrastructure, all of that kind of stuff is going on. And the other point I would make in terms of investment companies is there's a lot of focus in ESG on the E, but actually there's a significant number of investment companies also working in the S and the social purpose. And you can have, Eamon mentioned REITs, a property-based investment company, real estate investment trust. We've got some that are invested in social housing, for example, and therefore very much delivering a social impact in what they're doing. So you've got the S, and then I would argue on the G side, from a governance perspective, the investment trust structure, it is a company. It comes with an independent board that is there to operate on behalf of the shareholders. If you're a shareholder, you can vote, you can go along to the AGM, you can speak to the manager, you can speak to the board. You've got that sort of ability to behave as a shareholder, even though it's a fund, and that adds a layer of governance, which I think is important and shouldn't be overlooked either.
Yeah, I was going to ask, how much kind of are we seeing increased pushback now from shareholders in terms of kind of trying to direct the boards where they want to go on more, I suppose, issues of the the conscience, that kind of thing.
You're definitely seeing more investor engagement, and boards are trying to get more investors engaged. They want more investor engagement in the process. So, yeah, it's definitely something we're seeing, and we're seeing the emergence of platforms themselves making it easier for shareholders to engage with the investments they're invested in and to vote their shares. But you're also seeing the emergence of some business models where they're actively seeking that opinion from the underlying shareholders and sort of marshalling that voting on particular kind of campaign related issues, and making people aware that as investors you have a voice and you can influence that direction. But I think in the investment trust space in particular, there are a significant number of mandates out there which they're not necessarily badged sustainable or responsible or some of the other sort of taxonomy that you're seeing elsewhere in the market, but they're doing really good things in the ESG space.
Yeah. Deborah, I wanted to kind of pick your brains on the ESG side of things, because I think like I said, it's very easy to kind of pick apart any ESG portfolio, but it's interesting you've seen a real explosion of ESG ETFs in recent years. But there have been criticisms, for example, that even with, you were talking earlier about you need to look at what an ETF is investing in, what index it's tracking, that kind of thing is very important. But even with what is sometimes regarded as some of the stricter ESG focused indices, like, for example, MSCI's SRI range, you are still seeing sometimes, you might describe it as kind of like the best of a bad bunch being included. They'll still have exposure to something like your oil and gas, but they'll just choose Rio Tinto over something else. And maybe for some ESG investors, that's not good enough. Are you seeing kind of much of a response to that, or are many ETFs now kind of evolving beyond that?
The real challenge is ESG is very personal. So for some people, it could be, I don't want to invest in fossil fuel. For others, it could be about diversity on boards. And the challenge is, making products that are catering to a lot of people. So I think what you have found is indices, some of them are looking at exclusion. So they'll exclude tobacco, firearms, pornography, other kind of sin socks. Others, as you were alluding to, will look at best in class. So the leaders getting a diversified exposure to all the sectors in the core benchmark, because many professional investors are concerned about tracking error. So they still want to track well relative to their core benchmark, but they're looking at putting kind of an ESG filter on top of it. So there's really many different ways of thinking about ESG. And as you heard from Richard, most of the work so far has been around the E. So most people can agree on environmental issues and you can measure it, although the way it's measured isn't always the same. As you move to S, it's hard to get good data on diversity, on equal pay, on many things. GDPR is making it harder across Europe to get some of that data. So some is difficulty in data, quality of data, the amount of data. And then as you move to governance, we actually have had one ETF in the US that took an activist approach and was able to influence changes on Exxon board. So ETFs are even going into the governance thing. So I think you need to look at the different products that are out there and which ones match to how you think about it. But I would say what we have seen as kind of feedback after the war has broken out in Ukraine, some people are saying, well, weapons aren't so bad as long as they're being used for defense, right? And, there was this whole big, of course, you can't just say they're defense because someone has to be on the other side if you're using weapons, right? But certain weapons are definitely not okay. But then even the debate about nuclear fuel, France has been very positive, Germany's been against it. And I think what's happened with the energy situation, you've seen a rethink even here in the UK about nuclear. So, current events will potentially change and influence how people think about a lot of things.
Yeah, interesting. And I suppose at least with the passives, you do see those indices that they track do get kind of reconfigured every now and then. So they will hopefully be able to adapt to some of those evolutions. I was going to turn to another subsector now, and I wanted to talk about income just a little bit. And Emma, I might bring you in here on the trust side. You mentioned earlier, it was, yeah, perhaps a real strong moment for investment trusts. If we cast our minds back to 2020, companies were cutting or pausing or cancelling dividends seemingly all over the place at the time. Things, of course, have recovered to an extent since then. But as you said, investment trusts, they can put some money aside essentially, and that helped income trusts to keep up their dividends in many cases. How are things looking now? I mean, I suppose there were questions in the wake of 2020 about whether income trusts had kind of depleted their reserves too much, and perhaps they'd need to err on the side of caution. But yeah, how is the outlook kind of seeming if you're kind of an income hunter turning to investment trusts?
Yeah, I think there's a positive outlook. I think the UK and global economy, in terms of underlying dividends, bounced back probably quicker than a lot of people were expecting. And the trusts were able to either maintain their dividends or continue their historical record of annual dividend increases by drawing on these revenue reserves that they've been able to build up over time. A lot of investment trusts have also recently gained powers to pay money out of capital reserves and pay that out as income, which a number kind of use that advantage over the pandemic, with the view that they would then be able to rebuild those reserves once the underlying income had been restored.
It's interesting that, isn't it? For example, you mentioned, I think of quite a few JP Morgan trusts have taken on they effectively pay dividends out of NAV based on the NAV at the end of the year, which, some people argue, means they need to be less value and dividend chasing. But then, are there valid concerns there though about kind of if you're in a falling market that you're crystallizing losses and that kind of thing, or?
Yeah, I think it depends on what you're looking for as an investor. There has been a lot of examples, and you mentioned the JP Morgan funds. A lot of them did see kind of a re-rating after they introduced that policy. I think particularly retail investors did like that it was more certainty of income. So I think that helped. However, that there are risks. For example, if like a biotechnology fund, which has inherent volatility, if there's a policy to pay out a dividend based on year-end NAV, then investors should be aware of the potential volatility in the dividend if it's based on percentage of underlying NAV.
Yeah. And on the ETF side, I find the income case quite interesting. So there are a few options there. Maybe Deborah, I'll turn to you again if that's okay. It's just there seems to be an interesting divergence between some of the kind of dividend ETFs are quite high dividend focused, and perhaps they end up being quite cyclical, whereas some actually have kind of they attempt to build in almost like a kind of quality overlay, whether it's by kind of only including companies that have a long record of dividends and dividend increases or other metrics. I just wondered whether you kind of had any views on the options there, or any insights.
Yeah, you've alluded to some of the differences. So I think it's really important to look at the index methodology. So some are really going for very high dividend companies, and clearly companies that tend to pay high dividends are in certain sectors where the volatility of performance in that sector could cause some issues in terms of the overall performance of the actual holdings as opposed to the dividends. And so there's a lot of different ways you can invest in dividends. And there's also the ability to buy companies that are high dividend achievers, say in the UK or Europe or the US or other markets. So you need to think about what exposure you want in terms of jurisdiction, as well as what methodology makes sense for you, and are you being tilted toward utilities and other things as opposed to getting a broad, diversified sector exposure in addition to looking for higher dividends. So it's similar to the ESG dynamic that we talked about, just focused now on dividends as opposed to ESG.
Yeah, again, kind of the very important, not most exciting perhaps, but important kind of look under the bonnet mantra, which I always think is really useful. Well, yeah, some really interesting points there. I'm afraid we have run out of time. So maybe to kind of wrap up, let's turn back to the poll and just see, I'd be interested to see what people think. Interesting. So very, very balanced then. So the leading result is, yeah, hopefully unsurprisingly, then I guess kind of people think both. They like a mix and match. But there's still a big following for investment trusts, 40% favouring investment trusts, just 7% are kind of on team ETFs, so to speak, and then the same amount, again, relatively small amount, who kind of just want to do their own stock picking. So in an interesting mix there. But yes, as I said, I'm afraid that's all we have time for. So thank you so much to all of my guests for their really great insights. Thank you for watching. As mentioned, the session will be available on demand, and there are many kind of useful resources available above as well, including a feedback form if you have time to kindly fill it out and just give us your thoughts. If you wish to stick with us for more of the kind of hot investment topics of the day, then next up, you're going to get some Alex Newman and his guests talking about investing for income and the secrets to getting a kind of a good and sustainable income over time. But from us, that's it for now. Thank you again for watching and take care.